All right, folks. Hey, at the end of the second quarter, 2023, I neglected to make a video on my buckets, where my money's at, how it's doing, any moves that I'm making. Okay. The reason I did that, many of you know, I was in Colorado for a couple weeks, just seeing my son and seeing the country out there. So hey, let's do it now. Okay, so I have three buckets of money. If you recall, if you're new, hey, my name is Joe. I retired 4.5 years ago. And I've got a YouTube channel trying to share my journey. Okay. There are experts out there that I encourage you to listen to, financial advisors, a lot of specifics. I am one of you and going through this journey. I retired at 54, 59 right now. Okay. So 4.5 years retired. So bucket one, its purpose is to get me through a 4-year bear market. Market goes down 20%, 30%, 50%, trying to get through that from peak through trough back up to new peaks. This can absorb, based on the last 10 bear markets, this can absorb 7 out of the last 10, but that's only 70%, okay? 70%. And this allows me to sleep at night, okay? So when the market, like in 2022, goes down by 30, 35%, I don't panic. I've got 3.5 years. I got 3 more years, for that to recover. So this is the sleep at night, live your epic retirement, keep traveling, keep doing whatever you're doing in retirement. That's what bucket one is designed for. Okay. Bucket two's design is, remember that 30% of bear markets that may last 6, 7, 8 years? Bucket two, its job, and it's important you understand what each bucket is designed to do. That's to get me through years 5, 6, 7, and 8 of a bear market that just keeps on going on. And then bucket three is my long-term growth. I don't need the money there for 9 years. Okay. So, and I'm going to skip through something real quick. So where do I have bucket one invested? I've got it in CDs, money market funds, T-bills, I-bonds, and savings. And I'm delighted with the returns I'm getting in there now. When I originally retired at the beginning of 2019, I was essentially getting zero, 0.1, 0.2, nothing to be excited about out of bucket one. But with the rise in interest rates, this is looking good, But, you got inflation offsetting that, as many of you know. But it's in out of the market stuff. Market goes down 30%, bonds go down 15%. I'm just hunkered down, and it shouldn't affect me. Bucket two, I've got it in 60-40, 60% stocks, 40% bonds. These stocks tend to be dividend stocks, okay? And I go into Portfolio Visualizer. Why did I select this? And I looked at 5-year returns, 4-year returns. You could just say, okay, how is this arrangement in 4-year returns going back 50 years? How is it done? Well, kind of in the worst case of the particular funds that I picked here, it was like a minus 0.3%. So yeah, we may be in an extended bear, but hopefully these things won't do too bad. I'm kind of leaning on the scale a little bit, trying to get a little better returns with this 60-40. Some of you, if you want to be more conservative, you just put all of this over here and you got, 8 years, 4 and another 4 completely out of the market. That's okay to do. It's all up to your risk profile. Everybody's different. I feel comfortable with this. I know there's some risk associated with this. I'm comfortable with that. Okay. For me, that's just where I'm at. So that's what I've got invested here. Bucket three is 100% stocks. Okay. Just boring. No individual stocks. I got no individual stocks at all. Okay. So these are all mutual funds, exchange traded funds, anyway, just nothing exciting there at all. Okay. So where do I sit today? Well, today in bucket one, I got 5 years. Remember, I'm just trying to handle a 4-year bear market. What happened 5 years? Well, this bucket two at the end of quarter one was actually growing more. I had like five or so years in here. So I was able to buy a CD paying like 5.3% or something like that. And so I just shifted it over here. Okay. It's in my out of the market money. Okay. So I'm sitting here heavy at 5 years, and I'm still there after another quarter. I'll talk about that in a second. So I'm sitting here at 5 years in bucket one because I shifted at the end of last quarter some money over here. I still got 4 years, and so it can do its job. So every quarter, what I do is I sit down and I go, can this money do its job? Can it handle a 4-year bear market? Yes, I got 5 years in there. Can this handle a 4-year extended bear market from 4 years of, years 5, 6, 7, and 8? Yes, it can. Okay. And long term, I really don't look at that yet. Okay. So that's where I sit today. This is where that money's invested, and it's important. I tell you, I answer a lot of questions in the comments. Each bucket has a purpose. I get asked about, when do I rebalance my buckets? You don't rebalance your buckets. You look at them and say, can they do their job? Every quarter, I have a cadence just once every 3 months. I sit down and I look at where this is versus the money I spent. Now, normally, I ended, excuse me, I ended quarter one with 5 years here because of that movement over here. And I should be sitting here at 4.75, right? Okay, because I spent money for a quarter. Well, honestly, you folks are to blame here. YouTube and the consulting that I do, coaching on retirement, I made enough money to offset what I spent. So things are the exact same position. Didn't spend anything out of this bucket here because of you. Okay, thank you. Thank you for that. So I don't rebalance. I look at each one. You could technically call it rebalancing. I call it, can this bucket do its job? Can this bucket do its job? Can this bucket do its job? That's all I do. And a lot of people are critical of buckets. They say that the rules are complicated. And I'm like, I can't imagine it being any easier. It's extremely simple. I need bucket one to handle a 4-year bear market completely out of the market, so there's no drama there. I just think it's extremely easy. Okay. And then, the last thing I look at is how are these returning? Bucket three, my compounded annual growth rate since I retired is 9%. I could not be happier with that. I'm extremely happy with that, especially since we're just coming, we're in a new bull market now, but, everything's almost recovered there. I could not be happier. Recovered to new highs from the end of 2021. This one's returning right at 5% compounded annual growth rate, so over 4.5 years. I could not be more excited about that. This one here gets complicated because I got all kinds of different things working here, and timing of those different things. I didn't want to calculate that, but I'm doing much better than expected. It's much greater than zero. I got like I bonds that were paying 9.61 for a while. They're paying 6 something, and now they're paying 4 something. CDs, I got a few paying over 5. So it's just a little complicated. So that's my analysis that I do once a quarter with my buckets. Do you think this is complicated? Let me know in the comments what's confusing about this. I don't really think I rebalance. One of the things that's coming up in the near future is bucket 3. I'm going to have full access to that. I'm not 59 and a half yet. I've got some Roth here, and I've got mostly traditional IRA here, and I will be able to move that to these different funds if I want to. But if I had to now, say for example, I wanted to take some money out of this and put it over here, I could leave it in this pre-tax account over here, but just change where it's invested. I could have 10% CDs or 10% bonds over here, and in 6 months I'll have access to that to turn into real cash if I want to. So I think this is extremely easy. I may be missing something from you. of your concerns. So let me know in the comments what's confusing about this, what's complicated about this. I love it. It allows me to sleep at night. It allows me to just do whatever I want in retirement, like go to Colorado for a couple weeks. All right. Let me know in the comments where you're from. If you don't have anything else to say, let me know where you're from. I love seeing that. Just Joe out.